Hi, this is Nate Williams, and today we're talking about legal and smart tax deductions. Introducing college savings. Now, saving for college is very simple. You could simply put money into a savings account. You could stick money under your mattress. There are a lot of different ways you could do this. You could also pay for college at the time the child is in college with current wages at that time. So, in order to help your child through college and pay for college, you don't have to save in advance. The other thing is this is kind of a foreign concept to a lot of people, but the children could help save for and earn money for their college expenses. That's kind of a novel idea to a lot of Americans, but it builds a lot of character. And so there's a lot of parenting and parenting strategy that goes into giving your kids money and paying for college. I definitely don't recommend that it's just an entitlement that your kids just think they're going to go to college wherever they want and you're going to pay for it and foot the whole bill. I think it's important for them to have some skin in the game. So that aside, let's talk about a really cool savings vehicle called the 529 savings account. A 529 college savings account is a tax efficient way to save for college. The benefit is that if you contribute money into a 529 plan, the investment income is tax free. For example, let's say you contribute $10,000 into your child's 529 plan, and that $10,000 grows to $15,000. That extra $5,000, you normally would pay taxes on that extra $5,000 of passive investment income. But in this case, because it's in a 529 plan, it's tax free as long as you use the money to pay for qualified higher education expenses. Now, in addition, some states give tax deductions for contributions made into the 529 plan. So it depends on the state where you live, and if you can get that state tax deduction. We can help you determine what the rules are for your state. The 529 plan is ideal for parents who want to save money for college, but who also want to retain control of that money. A lot of parents think that I'm going to contribute money to a Roth IRA because they can use the Roth IRA for college. That is true, but note that with the Roth IRA, the minute your child turns 18, that money becomes unconditionally theirs and they can use it for whatever they want. So you may have thought it was earmarked for college, but they might take the money out and blow it on a new sports car or worse. So that's a little bit about 529 plans. I want to talk about a completely different tax deduction, but also relating to children, just while I've got your attention. The child care tax credit. If you have children under 13 years old, and if both parents work, which is almost everybody, if you're a Practice Financial Group client, because both parents are almost always on payroll, you can get a 20% credit for childcare expenses incurred for those children under age 13, up to $3,000 per year for one child or $6,000 for two or more children. So for example, let's say you have a 4-year-old who's in preschool 3 days a week and you both work. You can get a 20% credit for the cost of that preschool. Now, what you'll need to get from the provider is their name, address, how much you paid them, and their tax ID number. Now, any childcare provider is very used to giving out this information, so it's easy to get. I hope this is helpful.